Good evening, everyone. Thank you for joining us for tonight's webinar. My name is Royce Aguilar, Research Analyst of First Metro Securities, your one-stop investment platform for stock trading and mutual funds. Today, we are presenting Technical Analysis, a deeper dive with Recognia, to be delivered by Mr. Peter Ashton. He is Recognia's Vice President for Customer Success, who is joining us tonight from Ontario, Canada. If you have any questions during the presentation, please type them into the question box in your GoToWebinar control panel. Our presenter will answer them during the Q&A session at the end of the webinar. We encourage everyone to ask whatever you have in mind. This webinar is specifically for that and to those who want to utilize this tool to become better chartists and a stock trader. So after Mr. Ashton's presentation, we would be delighted to answer your questions. Now, without further ado, I turn you over to Mr. Peter Ashton. Good morning to you, Peter.
Well, good evening, and thank you very much for having me. Good evening, everybody, and welcome to this webinar entitled Technical Analysis and Recognia, a Deeper Dive. This is a follow-on to our webinar about a month ago, which is an introduction. So before I begin, I'd like to mention that we're going to talk about a number of real examples of stocks as part of this webinar, and everything that we talk about is provided for illustrative and educational purposes only. None of the information contained in this presentation is intended to constitute a recommendation by Recognia to buy, sell, or hold any stock, option, or securities. So in terms of the agenda for our webinar tonight, I'd like to begin by talking a little bit about what is technical analysis. We'll talk a bit about the history and the foundations of technical analysis. And we'll get into a little bit about Recognia's event-driven approach to technical analysis. And we'll specifically walk our way through three different types of technical events, those being the short-term patterns, the indicators and oscillators, and the classic patterns. And we'll actually do a live demonstration as well using the First Metro site to find and validate ideas using Recognia. And at the very end, we'll actually wrap up with a live question and answer session. So to begin with, a little bit of an overview of who Recognia is. We are a provider of technical, fundamental, and quantitative research worldwide. We've been around since the year 2000 and part of the Trading Central Group since 2015. We have major offices in London, Paris, New York, Hong Kong, and Ottawa, where I'm coming from today. And we provide global coverage of stocks, ETFs, indices, options, FX, and futures. So many of you may already be using technical analysis as part of your investing and trading. And for those of you, this is going to be a little bit of a review and perhaps a little bit of an extension to what you already know. But for those of you who are just getting started with technical analysis, I want to talk just a little bit about why it is we use it and what it is that technical analysis can help us with. So at its core, technical analysis is really all about looking for patterns in the price and volume history of securities that can tell us something about the attitudes of buyers and sellers. And if we think about every trade that takes place on an exchange, that trade represents an agreement between a buyer and a seller for what is the fair price of that security at that moment in time. And that fair price reflects everything that is publicly known about that stock or financial instrument, including the fundamentals, including the news, including the general market sentiment. So by following the changes in price, it can tell us something about the shifting balance of supply and demand for that stock in the marketplace. And that can help us to make better investing and trading decisions. Many people are surprised to learn that technical analysis is not a new thing. In fact, it actually goes back about 400 years to the rice markets of Japan. But modern technical analysis, like we practice today, really comes from Charles Dow. This is the same Dow we know from the Dow Jones Industrial Average. He was the first editor of the Wall Street Journal. And Dow observed the stock markets back in the late 1800s, and he believed that the markets tended to move in cycles. And Dow named those cycles the primary trend, that being the name for the trend that lasted anywhere from 9 months to 2 years. We have the intermediate trend, which is the green line in this picture, which is the trend lasting anywhere from 6 weeks to 9 months. And finally, a short-term trend, which lasts anywhere from 2 to 6 weeks. So what's important to note is that in some places, like for example here on the left-hand side of the chart, we have all three trends moving in the same direction, and that is upward. But other places, we have the trends moving in opposite directions. So over here on the right-hand side, we can see we have the short-term and intermediate-term trends moving up, but the long-term trend moving down. So Dow believed you had to understand these cycles to actually make good investing and trading decisions. So let's talk about an example of how we might use technical analysis. So here's a real stock chart. This is a company called Micron. And you can see it kind of has an interesting price history. So it had a big rally up to about $36, had a decline back down to about 10, started another rally back up and got to about $32 in this particular price chart. Well, how could you have used technical analysis to get a good entry point into this stock? Well, technical traders would have looked at a stock like this and said, I see a pattern developing here. There's a pattern called a head and shoulders bottom. This is what's known as a bullish reversal pattern in technical analysis, and it tells us that the previous trend is likely to reverse. So here you can see the trend had actually been down all the way from $36 in early 2015 down to a low of about 10 in early 2016. But this pattern tells us that the price is likely to reverse. And it's consisting of 3 successive rallies and declines breaking through this horizontal red line called the neckline on the 3rd attempt. Where we break through that neckline, it indicates that a previous level of resistance has been overcome. And that's often the start of a new rally. And that's in fact what happened here. When we broke through that neckline, it actually started a rally which went from about $18 up to about $32. Now let's talk a little bit about what's the traditional approach to technical analysis, and then we'll contrast it with how Recognia will let you work. So in traditional technical analysis, it's really all about looking at charts. And here's an example of a chart. Here's Apple, a very well-known tech company. And you can see we might look at this chart and say, what is technical analysis going to tell us about the price action in Apple? Well, maybe we'd start out by laying on a number of different kinds of technical indicators that many charting programs will let us do. So let's lay on, for example, the 21-day simple moving average. It's the blue line drawn here. So when the price crosses the moving average in the upward direction, that's often a bullish sign. That happened right here. Okay, so that's certainly bullish for Apple. What else might we look at? Well, let's look at the Bollinger Bands. And here you can see that the price of Apple is right on the upper Bollinger Band. That often is an indicator that the price of a stock is overbought and may decline. Okay, so that's probably bearish for Apple. What else? Let's look at an oscillator like MACD. Well, when MACD is above 0, that's considered to be a positive thing. It's bullish for the price of the stock, and that is the case right now, so that's good. And maybe we'll look at one more. Let's look at the relative strength index. When RSI crosses 70, that's often a sign the stock is getting overbought. We're very, very close to 70 in this example. We're at 66. Maybe the price of Apple is going to pull back. So I'm getting kind of a mixture of bullish and bearish indicators for Apple. So it isn't really clear to me necessarily what to do. So maybe I'll move on to the next stock on my watch list. But my watch list looks like this. There's lots and lots of different stocks that I want to look at. So you can see that this becomes a very time-consuming process. I'm going to look at many charts for each of these stocks on my watch list, and just for the watch list that I want to look at every day, this could take me a long, long time. And this, of course, is only a small number of the stocks or ETFs that trade in the market. So is there a different approach that might help us? Well, this is where Recognia comes in. So we have what is known as an event-driven approach. We automatically look at every single stock in the market every day, and we look at lots and lots of different kinds of technical indicators, much like I just showed you in my example. And we tell you when there's been events that may be of interest to you as a technical trader. So we basically have done all the heavy lifting for you, saved you that work of actually looking at all those different charts, and just highlighted for you the places where you want to spend your time. We automatically detect over 60 different kinds of technical events, and we do that on not just a handful of stocks like I showed on my watch list, but on every single stock in the market every day. And the great thing is that because we automatically detect all these events in our software, you don't have to be a technical expert. You can use our expertise to help you find stocks that are poised to move. Now let's just go through a little bit about some of those different kinds of events and talk about how they might be applicable to you and what you do. So I'm going to run through 3 different classes of events. The first one called the short-term patterns, and these are very, very useful for short-term traders, and they're based on the shape and relationship of candlesticks or price bars. Then we'll move on and talk about the indicators and oscillators, and then finally the classic patterns. I'm going to provide you just a few examples of each of these to kind of give you a bit more confidence that Recognia is actually handling all these things for you. Let's look at a first example of a short-term pattern. So this is a pattern called a hammer. And this is, by the way, on a real stock chart. This is Symmetrical. So here's our hammer pattern outlined here with the red box around it. So you can see why it's called a hammer. It kind of looks like a hammer. It's got a hammer head on top, and it's got a long handle coming down. So the hammer is thought of as a bullish reversal pattern. It tells us the previous trend is likely to reverse. So here you can see the stock has been sliding over a number of days or weeks. But on the day this hammer occurs, what is the sentiment of traders on that day? Well, they started the day fairly bearish because immediately the stock opened near the highs of the day and moved down lower almost immediately. But then something happened during the course of the day to cause them to change their perspective on this stock. The price rallied and we actually closed right near the high of the day, right here. So that can tell us that something has changed in the sentiment of traders, and that can be an indicator of a price reversal. And of course, in this particular case, the price did go on to reverse. It actually moved significantly higher over the subsequent trading days from about $27.50 up to over $31. Now, of course, the challenge of trading these short-term patterns is you don't get to see what happens next, like I had in my example. So how do we trade a pattern like a hammer? Well, when we see a hammer, we know this is a bullish reversal pattern. So for more aggressive traders, you might just say, okay, I'm going to take my position at the opening the next day, be prepared for that run-up. But of course, when I do that, I'm going to make sure I have a stop-loss order in place to protect myself in the event that the price happens to move in the opposite direction than I expect. But for more conservative traders, you might say, I'm going to just make sure that this reversal actually takes place before I actually enter my position. So I'm going to actually watch for a day or two and see if this reversal to the upside starts taking place. And if it does, then I'm going to buy my way into Symmetrical. Now you want to be careful though, because these short-term patterns, as the name suggests, have influence over a relatively short period of time. So the next 10 to 20 trading days is sort of when these short-term patterns are going to play out. Now, I'll give you a few other examples of short-term patterns. Here's one called the hanging man, and as the name might suggest, is kind of an ominous sounding name of pattern. This is a bearish reversal pattern. So it sort of looks like a man hanging by his neck with his legs hanging down. It has a small real body and a very long shadow, and a hanging man comes at the end of an uptrend in the price of the stock. So here the price has been increasing. We have a hanging man. This suggests to us the price is going to decline. Now, for a good hanging man, you want to have a shadow, or the wick that hangs down, at least twice the size of the real body. So this is not a good example of a hanging man because the shadow is too small compared to the size of the real body. Now, a hanging man can have either a white real body or a black real body. It doesn't matter. They're both equally applicable. But which one of these two hanging men is more significant? Well, the answer is that B is the more significant example of the hanging man because the shadow, or this wick, is much, much longer. This indicates a larger reversal in sentiment. So that's a better example of the hanging man than the one on the left. And as I mentioned, B here is still a better example, even though the body is now white, because a hanging man can have either a white or a black real body. Here's another example of a bearish engulfing pattern, of a bearish pattern. This is called a bearish engulfing pattern. And as the name suggests, an engulfing pattern is formed when we have a white candle followed by a black candle whose real body completely engulfs the real body of the preceding candle. So you can see that this white candle has been completely covered by the real body of the black candle. So for a bearish engulfing pattern, it always has to be a white candle followed by a black candle. We have a bullish counterpart of that called the bullish engulfing pattern, and as the name probably suggests to you, this is going to tell us that the price is likely to reverse to the bullish side. And again, we always have in a bullish engulfing pattern a black real body followed by a white real body like this. Now, these engulfing patterns, as I say, are reversals, so they tend to work better when they come at the end of a previous trend. So, for example, a bullish engulfing pattern is going to be better at the end of a sharp decline, and a bearish engulfing pattern is going to be better at the end of a sharp increase like this. Now, here's a question for you. Here's two examples of engulfing patterns. These are both bearish engulfing patterns because it's white candle followed by black candle. Which one is the better example of the bearish engulfing pattern? Well, the answer is the one on the right-hand side is the better example because it's stronger because the real body encompasses not just the real body of the preceding white candle, but also these wicks or shadows as well. So let's move on to our next class of technical events. These are called the indicators and oscillators. And for many of you, these are probably what you think of when you think of technical analysis. So indicators and oscillators are based on moving averages and various mathematical functions. And the reason why these are probably the best known kinds of technical events is because they are provided with just about every kind of charting package. So people think of these because they're so used to them in their charting packages. They're not any more indicative of price movements than the other kinds of technical events, but they're just more common because they're easy to calculate. And indicators and oscillators tend to come in three types. They have what we call trend following indicators, and these are basically mathematical techniques to smooth the price series so we can see the trends more clearly. We have what are known as momentum-based indicators or oscillators, which measure the speed or direction of price changes. They tell us how strong a trend is. And last, we have what are called the stochastics that measure the position of the closing price relative to the recent highs and lows. And one of the best known types of indicators and oscillators is the moving average. And this is something you've probably all seen before. And we have many different kinds of moving averages, but the one that just about every technical trader uses is something called the simple moving average. And the simple moving average is defined as the average price over the last n days. So if we're talking about the 21-day moving average, well, it's the average price over the last 21 days. Now, what we basically do is we just add up the closing price over the last 21 days and divide by 21, and that gives us the value for the moving average for today. Now, all moving averages tend to work best in trending markets, and people often ask, where do these time frames come from? Why is it the 21-day moving average? Why is it the 50-day moving average? Well, these are just all relative, and they come from just the history of technical analysis. So in some kinds of technical analysis, we use a 200-day moving average. That originally came from the silver market because Kodak used to keep a 200-day supply of silver on hand, and they were the biggest silver consumer in the world. We use a 4-month moving average in some commodities analysis because that's the shelf life of margarine. So here's an example. So here's a real price chart again. This is Hewlett-Packard, and I've drawn two different simple moving averages on this price chart. In blue, we have the 50-day simple moving average, and in red, we have the 200-day. And we could actually use these two simple moving averages in quite different ways. So you'll notice that the 200-day, the red line, actually forms a very nice level of resistance to the price of the stock. It's what's called a dynamic level of resistance because it's changing day by day. Notice how many times the price rallies and gets close to or touches the red line without actually breaking through. If we were to actually extend this price chart beyond the right-hand side of what's shown here, we might expect the price to bounce off that red line rather than breaking through. On the other hand, if the price did break through the 200-day simple moving average, that would be considered a bullish sign, where we cross the moving average as a bullish sign because a previous level of resistance has now been overcome. I've also got a 50-day simple moving average drawn on this price chart, and we could use the 50-day simple moving average in a bit of a different way. So if I actually plot with a green arrow where the price crosses in the upward direction, and I'll plot with a red arrow where we cross in the downward direction, I could have used this as a very simple trading system. So I could buy the stock when the price crosses in the upward direction, so I'll buy it right there. And I'm going to sell it, or better yet, sell short when I cross in the downward direction. So buy it here, profit from this uptrend. Sell short here, profit from this decline. Buy it here, profit from this uptrend. Sell short here, profit from this decline, and so on. So we have a number of other kinds of indicators and oscillators. I'll give you just a few examples, but we just talked about the price crossing the simple moving average. We also have what are called double moving average crossovers. So where two different moving averages cross over can also be a significant technical event. So what we're typically looking for here is the price of the, looking for the shorter term moving average crossing over either below or above the longer term moving average. So here I have an example. And I have the 50-day simple moving average drawn with a blue line, and I have the 200-day, the longer term one, drawn with a red line. So where we cross the shorter term one with the longer term one in the downward direction, that is bearish. So right here where I have this red square drawn, the 50-day has crossed below the 200-day, that is a bearish technical event. So right where this red square is where that's occurred. So we expect the price to decline following such a bearish event. And the price actually has declined a little bit since that has actually happened. So Recognia supports a number of different double moving average crossovers. We support 50-day crossing the 200-day and also the 21-day crossing the 50-day. Now, another technical indicator that I talked about very briefly in my introduction is what is known as the Bollinger Bands. These were developed by a guy named John Bollinger back in the 1980s, and they were one of the very first adaptive volatility tools used in technical analysis. So here you can see I have a real price chart, and this little dotted line in the middle, this is the 20-period moving average. And what I've done is around that filtered line, I've basically calculated two standard deviations on each side, so it's a statistical calculation. And what we tend to see in the Bollinger Bands is that that lower Bollinger Band becomes a level of support. The price will tend to bounce off that, and the upper level becomes a level of resistance. The price will tend to bounce off in the downward direction. So where we find the stock price touching this lower Bollinger Band, we often expect the price to rally, which here you see it's done. Hit the lower Bollinger Band again, it rallied. Hit the lower Bollinger Band again, it rallied, and so on. So this is often considered a sign of when a stock is considered overbought or oversold. We're overbought when the price touches the upper Bollinger Band, and we're oversold where we hit the lower Bollinger Band. And here's a technical indicator that's known best by its acronym, MACD or MACD. It stands for Moving Average Convergence Divergence, and it's used to identify overbought and oversold conditions. So the way the MACD is calculated is we basically calculate a 12-day and a 26-day exponential moving average, and then take the difference between them, and that becomes what's known as the MACD line. So this blue line is the MACD. We also often use in MACD what's called a signal line, this red line, which is basically a 9-day exponential moving average. So we have two different kinds of MACD events. When the MACD crosses above or below 0, that is considered to be either a bullish or bearish event. So right here where the MACD, this blue line crossed above 0, that is a bullish event. It's also a bullish event where the MACD crosses above its signal line. So where I have this red square, that's also a bullish event. So this green dot indicates the time where that has actually happened. So from this green dot on, we expect the price to rally, and you can see that's what's actually happened in this example. I'll do one more, which is relative strength, or RSI. RSI basically measures the strength of an instrument compared to its own price history. And the calculation basically is the number of up closes over the calculation period compared to the number of down closes. So a bullish signal occurs when the RSI crosses upward above 30, and a bearish signal occurs when the RSI crosses downward below 70. So where I have this red square right here, you see the RSI has crossed downward below 70. That indicates the start of a new bearish trend. So right where this red square is drawn on the price chart, we expect the price to decline, and you can see that price has actually started to decline right here. So that's a number of indicators on oscillators, and maybe I'll move on to the next class of technical events known as the classic price patterns. And I saved these because I saved the best for last. The classic patterns are not necessarily as well known as the indicators and oscillators, or even as the short-term patterns, but I think for technical traders in many ways they're the most useful, because in addition to telling us that something bullish or bearish is going to happen, they can also tell us a little bit more about what may happen next. And I'll give you an example. Here is a classic price pattern known as the symmetrical continuation triangle. So triangle because you can see it's got a triangular shape. And the price is basically, you're oscillating here in between an upper level of resistance and a lower level of support. And what's interesting is that those support and resistance lines are not parallel, but in fact they're converging. They're getting closer and closer together. So the attitudes of buyers and sellers in the market are getting closer and closer together. Now, eventually, either the bulls or the bears are going to get control of this stock, and the price is going to break out either above the upper level of resistance or below the lower level of support. That will be considered a bullish or bearish event. Now, in this example, the price has broken out above the upper level of resistance, so that is bullish. We expect the price to rally following a bullish event such as this. You can see the price has actually started to rally already. Now, this is known as what's called a continuation pattern. We have two different kinds of classic patterns, either reversal patterns indicating the past trend is likely to reverse, or continuation patterns where we expect the trend to continue. So here you can see the price has been in an uptrend already since November 2016. We sort of had a consolidation period where this triangle was, the price more or less moved sideways for a number of months, but where it broke out upward above the upper level of the triangle, that signals the start of a new bullish trend. And in fact, you can see the price did go on to rally from just a little over 17 to about 23. Now, what's very important when we talk about these patterns is the idea of confirmation. So oftentimes people will say, oh yeah, the price will be right about here, and they'll say, oh yeah, I can see a triangle is forming, so I'm going to actually buy. Well, it's not a triangle until you've actually confirmed it. In other words, it has to break out above that upper level of resistance or below that lower level of support. It's not a valid classic pattern until that happens. Now, I talked a little bit about the fact that these classic patterns are so useful because they can tell us something about what may happen next. So here, we can actually derive what's called the expected move, or the target price, by measuring the pattern height. So what technical traders will do is they will measure the height of the pattern from, here in the case, the broadest end of the triangle, and we're going to add that amount of price to the confirmation price. And that should tell us about how much we expect the price to move. So this pattern suggests the price should move to around $20. In fact, we did hit that, and in fact went much, much more than that. So this pattern worked out extremely well. We can also derive what is called the trading horizon. How long do we expect it to take to reach the target price? The way that technical traders do that is by measuring the length of the pattern. So from where the pattern began to where we broke out, that is the pattern duration, and we add that amount of time. So we measure this green amount and add this purple arrow to the confirmation date. And that gives us a rough rule of thumb for how long we think it will take to reach the target price. I'm going to go through a few examples of classic patterns, and in each case I'm going to give you the bullish pattern, but there's a counterpart, a bearish pattern as well. So let's look at the first one. This is what's called the triple bottom, and as the name suggests, this is basically a pattern that has 3 successive rallies and declines, breaking out above that neckline, that horizontal red line, on the 3rd attempt. So a little bit different than the head and shoulders bottom that I showed you before, because in this case all 3 declines are at about the same level. So here we broke out, and by the way, this green rectangle I'm showing you here, this is to indicate the target price region. So by measuring the height of the pattern and measuring the pattern duration, that gives us this green rectangle. So this dark green region at the top here, this is the target price. This is where the pattern suggests the price is going to go. And the width of this green rectangle tells us about how long we think it's going to take to reach the target price. So you can see again, this particular pattern, we broke through the neckline right where this green dot is, and we hit the target price in about half of the pattern duration. This one worked really well. Similar to the triple bottom, we have what's called the double bottom. So rather than 3 successive rallies and declines, we have 2. So here we had a decline and a rally to the neckline, decline and a rally breaking through that neckline on the 2nd attempt. So you can kind of see how this neckline represents a level of resistance. And again, in this case, we went on to rally and to hit the target price within the target price horizon. And bear in mind, I'm showing you the bullish pattern here, the double bottom, but there's a counterpart of this which is bearish called the double top. It would just be reversed from what you see here. And we talked about one example of a triangle. Remember, we talked about a symmetrical continuation triangle. Well, there are lots of other kinds of triangles. In fact, triangles are one of the best known kinds of technical events because there are 6 different kinds. We have some triangles that are continuation patterns like this one, and we have some that are reversal patterns. So top and bottom triangles are considered reversal patterns. So in this particular case, you can see we've been in an uptrend. We consolidated and actually went sort of down and sideways a little bit for a while this pattern formed. We broke out above that upper level of resistance, signaling the start of a new bullish trend. Upside breakout is another very popular technical term, or technical event. Here you can see that we basically have seesawed back and forth between a lower level of resistance and an upper level of support. We actually bounced off that upper support level twice before breaking through on the 3rd attempt. Sometimes these patterns are called flag patterns, and they occur fairly frequently. And of course, there's a bearish counterpart called the downside breakout, where we would have entered from the top and broken out below that level of support. The megaphone bottom is actually a very rare technical pattern, and it's rare because it represents kind of an unusual situation in the market. So think of a case of a triangle where we have those support and resistance lines getting closer and closer together. It indicates a narrowing difference of opinion between buyers and sellers in the market. Well, in the case of a megaphone, those lines of support and resistance are actually diverging. This tells us that the attitudes of buyers and sellers is getting further and further apart in the market. That indicates a market that is out of control. That's a very rare situation, but it does sometimes occur. But what has to happen in that case is eventually either the buyers and sellers are going to win the day, and they're going to get control of the market. And if in this case we've actually broken out above that upper level of resistance, and that indicates the buyers have now gotten control. So this is going to indicate that a new bullish trend is now underway, and in this case you see we've actually hit the target price in a bit less than the pattern duration. And diamonds are also fairly common kinds of technical events, and again they come in both continuation formats as well as reversal formats. And a diamond, kind of think of it like it's a bit of a megaphone starting out. Attitudes of buyers and sellers gets wider and wider, but somehow they start to converge, and we actually sort of finish the pattern looking a bit more like a triangle. So they're actually fairly common. You'll see patterns like diamond bottoms, diamond tops, as well as bullish and bearish continuation diamond patterns. And we're going to finish off with another one that's fairly rare, something called the rounded bottom. And what's interesting about the rounded bottom, or its counterpart, the rounded top, is that unlike a lot of the rest of the patterns we've looked at, where there's sort of a sudden change in sentiment and either the bulls or the bears has gotten control of the market, in this case the change of opinion takes place in buyers and sellers very slowly over a period of time. So for example, in this case you can see that the stock was actually declining, but very slowly over a number of months the attitudes shift, and all of a sudden now we've moved from a bearish market to a bullish market in this particular stock. But again, we can derive a target price in much the same way, and you can see here we actually hit the target price in about half of the pattern duration. As I said before, Recognia automatically finds over 60 different kinds of these technical events every single day. The short-term patterns, the classic chart patterns, as well as the indicators and oscillators. And we do this not just on a handful of stocks, but every single stock that trades in the Philippine market every single day. So we like to think that we do the heavy lifting so you don't have to. By automatically analyzing all these stocks, we can basically indicate to you what stocks are poised to move. Or if you've already got an idea, we can sort of tell you what all the technical analysis is saying about that stock today. So what I'd like to do now is actually turn to a bit of a live demo. So I'm going to shift from my PowerPoint presentation and go to a live demonstration on the First Metro site. So I'm going to just close my browser, just close my PowerPoint here. I'm going to go to the First Metro site. And first thing I'll do is I'll just show you where we can actually find Recognia. So we can find it in a couple of different places. And what I'd like to do first of all is actually show you where you might go to find some daily trade ideas based on technical analysis. So here's right on the main landing page. And you can see right here we have a panel that says today's technical events. So we've already scanned all the instruments in the Philippines, and we are basically saying for you for today, here's some interesting bullish and bearish trade ideas that you may want to consider further. So for example, for today's bullish events, we give you 5. Here's one called Arthland Corp. And it's interesting because it's had a triple moving average crossover. This is actually fairly rare. We've had the 4-day, 9-day, and 18-day moving averages all crossing over. This is a short-term bullish event. We have a stock here called Abowitz Power Corp. Again, a short-term bullish event. Here the price has crossed the 21-day moving average. East West Banking Corp. We've had a double moving average crossover, the 21-day, the shorter term moving average has crossed over the longer term moving average, in this case the 50-day, that's a bullish sign. And a triple moving average crossover in Metropolitan Bank and Trust, and so on. And because in every market condition there's people who are bullish and people who are bearish, we'll give you 5 bearish ideas as well. So here's an outside bar pattern on mega-wide construction. DMCI Holdings has had an inside bar. The price has crossed the 21-day moving average in the downward direction. That's a bearish event for Philippine 7 Corporation, and so on. So these are all ideas you can go on to do some further research on, but these are all stocks where technical analysis suggests there's going to be some price movement. Now, another way that you can use this tool is by looking up a stock you already know about. So perhaps you all have stocks you own in your portfolio, or a stock that you've read about in the newspaper, some interesting thing is happening with regard to that stock, or maybe you just owned the stock last year and you made money off and you want to try trading it again this year. How can you tell what technical analysis is saying about that stock today? Well, what we can do is we go to the heading here called Charts, and we have Recognia, and you see there's a link here that says Technical Lookup. So let's click on Technical Lookup, and here we can look up the technical perspective of any stock. So what I can do here we're starting off looking at the Philippine index. We'll come back to this in a minute. But let's suppose I have a few ideas of my own that I want to consider. So I did a little bit of research before, and here's a few stocks that I thought were interesting. So here's a stock called Asia Best. Symbol is ABG. And if I look at Asia Best, it's kind of got a little bit of an interesting technical history here. So I can see in the summary view there are currently 16 active technical events. I'm just going to scroll down and take a look at those events. So here's my price chart, and you can see that stock has been in a rallying since when was that rallying since? Since roughly this early summer of 2016. We had all these green dots. These green dots are the dates where we have had bullish technical events. We hit a high back in the summer of this year, and we've been declining ever since. So the price has moved from around 33 down to 19. By the way, this is in the local currency. This is Philippine pesos. And you can see all these red squares along the way. So these are the dates where we have had bearish events. So just for fun, we can put our mouse on this particular event right here. Notice this dot. We have some solid green dots, and we have some that have a little triangle inside. So the ones that have a triangle inside, this tells me these are classic patterns. I'm going to put my mouse on there. I'm going to click it. I'm going to actually draw that pattern on my price chart. So this is what is known as a symmetrical continuation triangle. This is a bullish continuation triangle. And it occurred right where we broke out above that upper level of resistance. That's right where the green dot is. The price when that happened was 21 pesos. The target price that we can derive with this technique I showed you of measuring the height of the pattern, suggests the price is going to rise to 29 to 31 pesos. This occurred on May the 8th, 2017. Well, did that actually happen? Well, the price immediately rallied after this particular triangle, and we got up to about 35, so we actually surpassed the target price suggested by this particular pattern. Now, that was all good news, and hopefully you were long in that stock when that happened. But then we started to decline, and in fact, right here we had a bearish pattern. We had a pattern called a double top. Remember we talked about the double top? There it is right there in this particular stock. So we had these two successive declines and rallies breaking through that neckline to the downward direction, right where this little red square with a triangle inside of it is located. This occurred on August the 10th, 2017. This is what's known as an intermediate term bearish event. The price when this occurred was 25.60, and this suggests the price is going to decline to the range between 17.50 and 19 pesos. So what happened? Price declined, and we got down to about here, about 18 or so is the lowest point we got to. So again, this particular pattern worked well. So here in this one stock, you can see how you could have used classic patterns to tell you both when to get in and when to get out, or to be short the stock. Let's take a look at another example. Let's look at one more bullish one, and then we'll take a look at a bearish one or two. So I'm going to look at another stock that I was looking at earlier called Ayala Corporation. And by the way, I wanted to also show you that, remember we talked about the fact that Charles Dow had these different time horizons that he thought you should look at stocks in. He talked about the short-term, intermediate term, and long-term trend. Well, we also provide those trends here. So we have the summary view, which is going to show you all of the events that are currently active. But let's suppose you're just looking for a short-term trade. You want something you're in and out of in the next 2 to 6 weeks. Well, then for you, maybe what you need to be looking at really is mostly the short-term indicators. If you want to be in something a little bit longer, say 6 weeks to 9 months, you can look at the intermediate term. And we also have long-term indicators, which are lasting more than 9 months. I'm going to go back to the summary view. And for this stock, Ayala Corporation, you can see it's been a pretty bearish perspective ever since I guess that looks like about December 2016, we kind of hit a low, and the stock has been rallying ever since. And in fact, we've had all these bullish events along the way. We had a bullish event here back in May, had a classic pattern in July, and so on, many different technical events which have accompanied this run-up in the price of the stock. And again, I like these classic patterns. I think they're very indicative. So let's click on this particular one here with the green triangle. Here is a pattern called an upside breakout. Remember we talked about the upside breakout, sometimes called the flag pattern? Stock is rallying, basically consolidates between a lower level of resistance and an upper level of support. We finally broke out above that upper level of resistance on July the 26th. That confirmed the upside breakout pattern. The price at the time this occurred was $8.95, and the suggested target price was $9.41 to $9.52. Well, did that actually work out for us? Well, yeah, the price actually got up. Well, we're trading right now where this orange marker is at just over 1,050 pesos. So this particular pattern also worked out really well. So that's two examples of bearish patterns. Let's look at some some bearish examples. So here's one called Surpass that I was looking at earlier. Surpass Inc., currently trading at 575 Philippine pesos. And in the summary view, we currently have 14 active events. And by the way, if you scroll down to just below the price chart, we actually give you a synopsis that there currently are 6 bullish and 8 bearish events in total. But this is certainly a stock that's looking pretty bearish. So we've been in a decline for quite some time. You can see most recently we've had a whole bunch of red bearish events, but most recently here, there's certainly been a preponderance of these green dots. So just looking quickly at that, and what I can do is I can actually zoom in a little bit. You can see that we've actually had a fair number of bullish events. I'm going to just move this over. This chart is fully interactive, by the way, so I'm going to just zoom in a little bit. So you can see that when the stock was declining, right in here, we had all these different bearish events taking place. But more recently, we've had more bullish events than we have bearish. So let's just take a look at the short-term history. So just looking at the short-term patterns, we currently have 4 active bullish short-term patterns against only 2 bearish. In the intermediate term view, though, we have 2 bullish and 3 bearish. So the stock is still looking fairly bearish in the intermediate term, but in the short term, it's actually looking more bullish. So this may be one of these situations where, although the primary trend is downward, we may actually go on to see this stock rally in the short term. Here's an interesting technical pattern here. Here's what's called a megaphone top. This occurred back in, when did it occur? July of 2017. The price was trading at 730 when this occurred, and our target price was 560 to 590. So there's that megaphone top. Remember I told you that megaphones were fairly rare technical events indicating a market that's out of control? Well, that's what happened here. We basically had this bigger and bigger swings between the support and resistance level, eventually breaking out below the lower level of resistance right here where we have this green square, and we expect the price to fall to 560 to 590, and we didn't, we actually got down to 503 right here. So this one did hit its target price as well. So you can see how these classic patterns can certainly be very good indicators for you of future price movement. So I also wanted to mention before we go on that we also can highlight indices. So you can look at the let's try the symbol guide here and see if we can. Oh, that's not going to work. We can certainly go back to the dynamic chart or the technical event lookup here, and this will give us, I think by default, the Philippine index. But you can also look at indices as well as individual stocks using this tool. Now, if you forget everything that I told you, there is some built-in educational content. So we have what are called the Getting Started guides. So again, under Charts, you can click on Getting Started. We have a Recognia Getting Started guide here where you can actually click on to get a PDF document providing you with how to use the technical event lookup. So that's been a lot of me talking. It's about 45 minutes into our webinar. So I think this might be an appropriate point for us to move to the question and answer session. So I'm going to go back to my PowerPoint presentation. And I will mention just before we go, I hand the presentation back to our host from First Metro, that we have many, many other kinds of resources on Recognia's website. You can go to our traders resources page, www.recognia.com/resources/traders, and you can find lots of other resources, including white papers, industry articles, FAQs, and so on. Lots more information for you if you want to learn more about technical trading. So at this point, let me hand it back to First Metro, and we'll begin to run the question and answer session.
Okay, so before we move on to our question and answer session, I would like to invite everyone in Metro Manila who would like to know more about analyzing PSE-listed companies and a more in-depth review of technical analysis and stock trading in general. We are having our last round of Gift Guided Investor Fearless Trader here in NCR for the year. Catch this run on October 21 to 22, 2017 in Alabang. Do follow our Facebook page or join our Viber public account for updates regarding this and for other events. Okay, now it's time for our question and answer. So if you have any questions, don't hesitate. This is a once-in-a-lifetime opportunity to ask Mr. Peter Ashton. So if you have questions, please type them into the question box in your GoToWebinar control panel.
And I see we have a number of questions that have already come in during the course of the webinar. That's great. So I'll begin asking some of them. So here's a question saying, what are the most reliable patterns historically? So Recognia doesn't have any opinion on the most reliable patterns. In fact, we think of ourselves as being a resource to you to basically help automate the standard practices of technical analysis. So we're not putting these forward as a crystal ball, but rather these are the same kinds of events you would read about in a good book on technical analysis, and we're going to help you to find those in an automated kind of way. The difficulty in answering the question of, what's the most reliable historically really depends on market conditions. So for example, if we're in a strongly trending market, then for example, the continuation patterns are going to work very, very well. The reversal patterns are not going to work so well. However, we start getting into more of a choppy sideways market, then the reversal patterns are going to work very, very well, and the continuation patterns not so well. So the answer really depends on market conditions, and I wouldn't really advise you to trade only on a single kind of indicator or a single kind of event. What you want to do, and what the best traders are going to do, is consider as much information as possible. So I'd like you to look at all the different kinds of technical events. What is the weight of evidence telling you about the market direction? So we can look at all the different technical events. If you find there's 15 technical events and 12 of them are all bullish, that sort of suggests that the price is likely to rally, and that's the way that the best technical traders tend to operate. Here's another question about how frequently should I check Recognia's technical event lookup tool? Another great question. So I think it really depends a lot on you, the trader, and what you're trying to accomplish. So if these are stocks you already own in your portfolio, then I would suggest probably once a week would be a good time frame to come back and check, what's actually happening. Have there been significant changes? If you're a short-term trader and you're looking to hold things for only, a few weeks at a time, or maybe even only a few days at a time, then obviously you need to check more frequently. You need to come back and check every day. That leads to another question, which is really, when does Recognia do its analysis, and when is the analysis on the First Metro website updated? So Technical Insight is what's known as an end-of-day technical analysis tool. We're doing our analysis on daily and weekly price bars. And to do that, the market needs to be closed. We have to have all the data from the day to do our analysis. So we receive our data from the stock markets soon after they close in the late afternoon to early evening. We do a bit of cleaning up of the data and we run our analysis. Typically in the early evening around 9 o'clock is when the analysis is updated on the website. So typically, before the market opens the next day, you can expect all the day's analysis to be updated in there. Somebody had asked about whether this presentation slide deck is available for download. I will certainly make this presentation available to First Metro, and hopefully they can find a way to get it out to the people who have joined this webinar today. Another question, this is from someone named Vanessa. In technical analysis, don't you also need to include volume as an indicator and not just the patterns themselves? Do you have volume indicators in Recognia? So great question. So the answer is yes. In technical analysis, volume is also a very important indicator. So we certainly show you the volume in all the charts that we provide. So we had those price charts, but right below we'll also show you the volume. What I didn't really talk about, but what's built into our analysis is that in order for an event like a classic pattern to be valid and to be found by our software, there are certain volume criteria that have to be met as well. So, a pattern that occurs on very, very weak volume, for example, would probably be filtered out by our software. And we're going to focus on providing the ones that have confirmation on volume as well. What's the best time frame to trade for newbies in the stock market? Well, I think if you're a newbie in the stock market, certainly I want to encourage you to use lots and lots of different kinds of investment research, not just technical research, but maybe you want to include some fundamental research in there as well. I think the key thing is to recognize that when you're new to anything, you're probably going to make some mistakes. You want to be careful with your capital and make sure that you're not making silly mistakes that are costing you money. So I would encourage you to probably think a little bit more about the intermediate term and longer term trading if you're new. So short-term trading, day trading, and so on is actually really for experienced traders and not for people who are new to the stock market. So what you probably want to do is start out with more intermediate term trends, and when you start to build some confidence and find some things that work for you, then maybe working down towards more shorter term trading. But for some people, they just don't have the time to be a short-term trader. Being a short-term trader means doing research every single day. So if you don't have that kind of time, you probably want to focus more on the intermediate term and longer term trading. When should we buy a breakout? At the close, when the price closes above resistance, or should we wait for something before we buy? That's another great question. I think the answer really depends on the sentiment or the attitude of the trader themselves. So I think if you are a very aggressive person and you want to benefit from all the possible upside that's going to come from a technical event, you can certainly buy at the open the next day following the breakout in a stock. And that's certainly, I know lots of people who do that. And if you're going to maximize your profit, that's kind of the way you need to enter. You want to get the best possible entry point, so you probably need to get in fairly quickly. Of course, if you do that, you want to make sure that you have a stop loss order. So in the event that price happens to go in the opposite direction that you expect, you're going to protect your capital. Or if you don't have a stop loss order, at least be keeping a very, very close eye on the stock. Other people who are more conservative are going to want to perhaps watch for a day or two. And let's see if that reversal does take place. Once I've seen 1 or 2 days of reversal, I have more confidence that maybe a new uptrend is underway, and maybe that's when I want to enter my position. So you're giving up a little bit of perhaps upside in the stock in exchange for a bit more confidence in the pattern actually taking place. So here's a question, and this is actually a very good question. So it says, in today's technical events, you showed that stock with symbol M wide is both on the bullish and the bearish list. What do you do in this case? So that's actually a great question. And in fact, that is certainly possible. You can have both bullish and bearish events in an individual stock in an individual day. So very first thing is, if we went back and looked at that, I would guess, and I don't know, but I would guess that those two technical events were taking place in different time horizons. So remember that Recognia has 3 different time horizons we do our analysis in. We have the short term, which is events that'll play out in the next 2 to 6 weeks. The intermediate term, things that'll play out in the next 6 weeks to 9 months, or the long term, things that'll play out in 9 months or more. So what's certainly possible is you have a bullish event in the intermediate term, but a bearish event in the short term. That can certainly happen, and in fact that's actually a very favorable scenario for you to look for, because what it indicates is a price that may rise in the intermediate term, but you may get a better entry point in the short term because there's a little bit of price weakness in the stock. So we need to look at, first of all, the time horizon associated with the event. Even then, it's certainly possible to have both bullish events and bearish events in the same time horizon. It's because different technical events are telling you different things. So for example, maybe it's possible we had the price crossing the 21-day moving average in the upward direction. That's bullish, but the price has also risen now to the point where it's touching the upper Bollinger Band, and that can indicate a condition which we call overbought, which can be actually bearish. So we can certainly have both those kinds of things happening at the same time. We just have to recognize different technical indicators are there to tell us different things. When you have conflicting signals like that, I always say go back to the first principles of technical analysis, which is what is the weight of evidence telling you? If the vast majority of things in a stock are bullish and just a few things are bearish, the weight of evidence is telling you the stock is bullish. In a situation where you had a stock that had equal numbers of bullish and bearish events, it means the market is mixed. It doesn't have a clear direction. That is fine. That can actually happen. What do you do in that case? You move on to the next idea. You don't have to trade that stock today. What else can we do here? Lots of questions about will this be available for download? I'll provide this presentation to my First Metro hosts at the end of this. Here's a question: do we use pivot points in our analysis? So there is built-in pivot point analysis in what Recognia does. So in fact, when we find those classic patterns, things like a triple bottom or an upside breakout, and so you see we draw on the chart those red lines and we sort of show where the price is reversing. That is our pivot point analysis that is done to determine that. So we're actually using pivot point analysis as part of our classic pattern recognition. Let's keep on looking at some questions here. Here's a question from someone named Jod. Are Recognia events real-time, or are they available at the end of the trading day? So Technical Insight is an end-of-day technical analysis tool. So none of the analysis is updated during the trading day. It's updated at the end of the day. We have to have the full day's supply of data to do our analysis. So by definition, the market has to be closed. We do our analysis in the evening. It will be available to you before the market opens the next day. Here's a question: where can I find the list of indices and chart patterns for the day? I think maybe the question here is perhaps the question is, what are the different technical events that are available? And if you are interested in that, I would refer you to the Recognia website. We have a section called Traders Resources. In those Traders Resources, you will actually find a paper that basically provides more information on all the different technical events that Recognia covers. That might be a very interesting thing for you to look at. Do you use Fibonacci retracement? So Fibonacci is another very popular kind of technical analysis. It is actually not used in what we do in our Technical Insight product. Here's a question again from Jod: which double moving average crossover gives more weight? So we don't assign any particular importance to the different kinds of double moving average crossovers. Remember, we have 2 different kinds. We have 21-day crossing 50-day, and we have 50-day crossing 200-day. We don't want to say that any one is more weighty or more important than the other. I think what is important, though, is that those 2 types of moving average crossovers have different time horizons associated with them. So the 21-day crossing the 50-day, that would be known as a intermediate term technical event, where the 50-day crossing the 200-day would be a long-term technical event. So they have different time horizons in which those events would play out. Here's a question: how much of your portfolio should you put in a trade, and what is the ideal cut loss percentage? So I can't tell you how much of your portfolio to put in a trade. I think it would certainly depend on your risk tolerance and how much capital you have. But I think what you want to be careful of is that you're not getting yourself into a situation where you can have one bad trade and that's actually going to decimate your whole portfolio. So oftentimes you'll hear people talk about not having more than 5 to 10% of your portfolio in one individual trade, and that's a good practice because it basically limits the downside you had in any trade at all. What's the ideal cut-loss ratio? I think cut-loss you're probably referring to a stop-loss ratio. Again, that really depends on you, the kind of trader you are, what your risk tolerance is, what your time horizon for investing is. People often, though, talk about stop-loss ratios in the 5 to 10 to 15%, meaning that if the price drops, 10% from where you bought the stock, you're going to basically exit the position. So I think that's probably a good number of the questions we've gone through, and we're coming very close to the end of our time. We have only about 4 minutes left. I'm going to pass the webinar back to First Metro if they have any closing remarks, and I think at this point we can close it up. But we'd like to say thank you very much for everybody for joining us, and I hope this has been helpful and hope this provides you with some further ideas of how you can use technical analysis as part of your investing and trading.
Thank you, Peter. That was a very informative webinar. I'm sure everyone learned a lot today. Personally, I knew that the prices moving trend, how to utilize RSI, MACD, moving average. We also learned the different continuation, reversal patterns. We had triangle, double, megaphone, rounded top, bottom, and head and shoulders. And most importantly, in Recognia, it quickly determines the different patterns of a stock. Now, we would like to thank everyone. We appreciate you joining us today. Again, for everyone in Metro Manila who would like to know more about analyzing PSE-listed companies and a more in-depth review of technical analysis and stock trading in general, we are having our last round of gift, Guided Investor, Fearless Trader here in NCR for the year. Catch this run on October 21, 22, 2017 in Alabang. Do follow our Facebook page and join our Viber public account for updates. Thank you, Peter. Thanks again. Thank you, everyone, and we'll see you next time. This has been your host, Royce Aguilar, and good evening.